Investors are dumping high multiple tech for defensive safety, sending healthcare surging 2% as the S&P 500 edges lower in a massive sector rotation. Today's 3.1% liquidation in the SOXX isn't broad market panic. It's the hardware sector front-running a structural margin collapse. While fear indices remain neutral, Level 2 policy risk is finally pricing a permanent geopolitical tax into the global semiconductor supply chain. We are exiting the AI growth narrative and entering a regime of mandatory, high-cost domestic fab redundancy. The VanEck Semiconductor ETF earns a buy rating with a lab score of 63. SMH dropped 2.61% today to 561.25, yet institutional capital injected $397 million in fresh net inflows. Retail sentiment fears the 74.8 RSI overbought signal. The lab sees a strategic liquidity play ahead of the Cerebras IPO. This fund is not a broad semiconductor play. It is a concentrated bet on a three-company monopoly. NVIDIA at 18.1% dictates the momentum of the entire tape. TSM at 10.6% represents the physical bottleneck of global sub-5 nanometer production. Broadcom at 7.8% captures the networking layer essential for data center scaling. Analysts call this diversified exposure, but that is a marketing fabrication. VanEck markets SMH as diversified exposure, but the structural math tells a far more aggressive story. Nearly 50% of this fund's total weight sits in just 5 companies. You are not buying a broad sector. You are buying a concentrated bet on the silicon-to-software AI hardware stack. NVIDIA and TSMC alone command nearly 29% of the total net asset value. This creates a dangerous single point of failure within the global foundry supply chain. If TSMC faces a geopolitical tremor or a lithography delay, nearly a third of your capital evaporates instantly. We see a glaring structural flaw in the 7% allocation to Intel. Intel remains a legacy fabrication play struggling with its foundry transition. Institutions are aggressively reloading the VanEck Semiconductor ETF while retail investors flinch at tariff headlines. The lab tracks a 5-day to 20-day volume ratio of 1.40. This signifies a massive surge in capital inflow. Mainstream media fixates on trade war uncertainty and fragile truces with China. We see a different structural reality. SMH is currently trading at a 2.62% discount to its net asset value. This gap reveals a disconnect between panicking retail sentiment and the actual value of the underlying hardware. While the public sells the narrative, the smart money buys the assets at a discount. Momentum remains overheated with an RSI of 74.8. This typically signals a cooling period, yet the price holds firm above the 50-day moving average of $441. The lab recognizes this as institutional absorption of retail supply. The PR narrative suggests that export controls will cripple these companies. We disagree. Global compute demand is decoupled from regional trade policy. The hardware inside this fund is essential, not optional. We are watching a classic head fake where political noise masks a structural accumulation phase. The massive year-to-date performance is not a peak. It is a baseline shift for the entire sector. High-volume inflows at a deep NAV discount prove that the largest players are positioning for the next leg up. They are ignoring the press releases and following the silicon. The current volatility is a gift for those who understand the engineering behind the trade. SMH is an institutional conviction play disguised as a geopolitical risk. SMH is not a broad semiconductor fund. It is a concentrated bet on the NVIDIA TSMC hardware monopoly. While marketing materials promise diversified exposure, the top 2 holdings control nearly 29% of the total NAV. We see this as a structural vulnerability rather than a safety net. The lab tracks the AI ETF score at 63 out of 100. This reflects a sector that has outpaced the Nasdaq but is now hitting physical limits. The engineering reality is simple. The 5G smartphone cycle and AI GPU demand are redlining the global supply chain. Current U.S. tariff policy acts as a direct tax on semiconductor margins. These costs do not just disappear. They erode the bottom line of every mid-cap holding in the fund. We are watching the RSI hit 74.8. That is deep overbought territory. Retail sentiment sits in fear at 42, but the technicals tell a different story. A bullish MACD crossover suggests momentum remains. However, the structural resistance at 589.31 is the hard ceiling. We do not view the chip shortage as a sign of strength. It is a production bottleneck that caps revenue upside for the entire basket. If the 533.19 support level fails, the concentration risk becomes a liquidation trap. The lab verdict is clear. SMH is an overextended momentum play that requires a cooling period before the next leg up. Avoid new entries until the RSI resets below 60. To evaluate the iShares Semiconductor ETF, I have analyzed the unprecedented year-to-date performance against current hardware supply chain constraints and margin structures. SOXX shed 3.15% today to close at $515.99, signaling a structural cooling of an overbought engine. While the media fixates on 2018 comparisons, the lab tracks a different metric. The RSI hit 71.1 this week. That is a clear technical signal of an overheated sector. We are seeing a high-velocity pullback from an unsustainable 5,340% year-to-date trajectory. This figure represents a massive performance outlier that demands immediate scrutiny of the underlying components. AMD holds an 8% weight in this fund. Its shift toward the MI300X accelerator is the primary growth driver here. Broadcom also sits at 8% of the NAV. It provides the networking backbone for every major hyperscaler. Then we have Micron at 7.6% of the total weight. Memory revenues are projected to triple by 2026. This is not speculative noise. This is a hardware reality driven by HBM3E demand. Wall Street calls today a sell-off. We call it a necessary decompression of the taco level 2 risk. The upcoming China diplomatic visit creates a fragile truce for these global supply chains. Any export control on high-end GPUs hits 16% of this fund's NAV instantly. The current MA20 and MA50 alignment remains bullish despite the daily drop. This movement is a structural rebalancing, not a fundamental collapse. The fund's heavy concentration in custom silicon and memory makes it a pure play on AI infrastructure. Short-term volatility is the price of admission for this level of hardware dominance. SOXX is undergoing a high-velocity cooling period before the next leg of the AI infrastructure build-out. SOXX is dragging a 6% anchor named Intel, while its competitors sprint ahead. The marketing narrative promises broad semiconductor exposure for 35 basis points. The reality inside the fund DNA is a structural mismatch with current hardware cycles. While the YTD return shows a staggering 5,300% surge, the 3-year average of 58% tells the real story. We are seeing a massive divergence in engineering efficiency. Over the last month, SOXX trailed the equal-weighted XSD by 13 full percentage points. This lag is not a fluke. It is the direct result of holding 6.3% in Intel. In the lab, we view Intel as a legacy foundry play, not a high-growth AI constituent. By contrast, NVIDIA sits at only 6.8% of the fund. This near-equal weighting of a market leader and a struggling turnaround story is a fundamental design flaw. The top 5 holdings command nearly 37% of the net asset value. This concentration is sold as stability, but it actually creates a performance ceiling. While fund flows suggest institutional loyalty, the internal composition proves SOXX is misaligned with the AI compute shift. You are paying for a diversified basket that is actually a collection of legacy drag and missed momentum. We see a fund that is structurally incapable of outperforming concentrated peers in a specialized hardware bull market. SOXX is an obsolete index design masquerading as a modern technology vehicle. SOXX is currently trading at a staggering 3.164% discount to its net asset value. This is the single most important data point in the semiconductor space right now. While retail sentiment flinches at headlines regarding tariff uncertainty, institutional capital is aggressively positioning for a massive breakout. We track a 5-day to 20-day volume ratio of 1.35. This confirms a heavy net inflow into the fund's underlying hardware components. The lab views this NAV discount as a rare structural arbitrage opportunity for the disciplined investor. Mainstream media focuses on the fragile truce with China and the noise of potential trade wars. They are reading the wrong script. SOXX has delivered a staggering 5,340% return year-to-date. This performance masks a dangerous structural divergence within the fund's architecture. We see 16% of the total net asset value locked into just two names, AMD and Broadcom. While Wall Street chases the general AI narrative, the lab is tracking the margin erosion at legacy constituents like Intel and Texas Instruments. New tariff structures on imported silicon are not mere noise. They are a direct tax on the gross margins of these foundational holdings. This creates a performance gap between high-performance compute and the legacy analog components currently dragging on the fund. The 5G product cycle remains the primary structural tailwind for the next quarter. It specifically drives demand for the radio frequency and power management hardware, where Broadcom maintains a technical moat. However, the engineering reality of the supply chain is under threat. Ongoing U.S.-China trade tensions are no longer a macro headwind. They are a localized risk to the sub-7 nanometer production lines. The technicals are now flashing a clear warning. With an RSI of 71.1, the fund is pushing into overbought territory. It is hitting a critical resistance level of $541.79. The lab's AI ETF score sits at 63 out of 100. This reflects a neutral stance in a market currently gripped by fear. We do not buy the extension into overbought levels while trade policy threatens the core constituents. SOXX is a tactical hold until it flips the $541 resistance into confirmed support. Today's data confirms a structural buy signal for semiconductor ETFs. Is this 63 score a genuine entry point or a bull trap before a deeper correction? Comment your call below.